Hey everyone, welcome back to the stocktrades.ca YouTube channel. My name's Dan, one of the co-founders of stocktrades.ca. We're a Canadian-based investment website that caters to millions of Canadians on a yearly basis. As of filming this video, actually, I think we've just broke around 1.7 million visitors thus far, and we're only in July. So a lot of people rely on us for stock research, investment guides, and industry analysis. So as a result, we've had a lot of requests from whether it be website readers or you, YouTube subscribers. And also, if you haven't subscribed, head down below, subscribe to the channel, like the video if you like it at the end of it. And they've been asking us how we analyze these stocks. How do we come to the conclusion that a stock is a good fit for, say, our market-beating premium service or even a YouTube video? And the reality of it is, to explain it in a single YouTube video would be extremely hard. So I'm going to try and break it down into parts. And today I'm actually going to go over, in my opinion, the most important financial document you need to have knowledge with if you're going to be a successful self-directed investor, and that is the balance sheet. The balance sheet is the one financial document that is going to give you very quick insight on the overall health of a company. And the fortunate thing is, it is one of the easiest documents to read. An alternative name for the balance sheet is the statement of financial position. And it essentially highlights over the course of 3 months in terms of a quarterly report, or the course of the fiscal year in terms of an annual report, the company's overall financial position. You're going to get three main things on the balance sheet. You're going to get the company's assets, the company's liabilities, and shareholder equity. And the most important thing with the balance sheet is the fact that it balances out. The company's total assets must equal the company's total liabilities plus shareholder equity. So you're not going to see much of me in this video. I'm actually going to turn around here to the computer. We're going to start off with looking at a balance sheet and discussing it line by line, what each line means, what you should be looking out for, and what you should be avoiding. And then I'm going to highlight a company with a very healthy balance sheet versus a company that has a poor balance sheet. So let's get into it. So for this video, we're going to be looking at Aritzia's balance sheet. They're a popular and fast-growing clothing line here in Canada. They're more of a pure growth play instead of an income option. And the one thing I'm going to say before we do get started is the place you want to find these balance sheets or these financial statements is in the company's investor relations page. You don't want to go to Yahoo Finance. You don't want to go to Zacks. I mean, they have this type of information. They don't guarantee the accuracy of it. The way you will get a accurate, 100% accurate report is to head to the company's actual investor relations page. So it's as simple as, if we're searching for Aritzia's financial statements, we would head to Google, Aritzia Investor Relations. It's going to be the first link you're going to find. And you're going to get to a page like this. And more often than not, every single company's website will be different, but generally they will all link to the same things. This management's discussion and analysis, or MD&A as they call it, is essentially where management discusses the quarter with shareholders, and they provide forward-looking information like guidance. It is a good place to go to get an outlook on the company from a management's perspective. But if you want to just look at raw financial statements, you're going to want to go to the financial statement section. So if we click here, Aritzia's is actually fairly simple. The balance sheet is actually the first thing that comes up on the second page. So these balance sheets are in thousands of Canadian dollars. That's what most of them are going to be. If you have a company that generates a lot of revenue, it might be in millions of Canadian dollars. And at first, these numbers might confuse you. So if you actually want to do the calculations, you can take say Aritzia's cash and cash equivalents of 224,313 and times that by 1,000, and you're going to get 224,313,000. So another common name for the balance sheet is the statement of financial position. They are the same thing, just different ways to say it. So if you are looking at some of these quarterly reports, which can be fairly extensive, and you can't find the balance sheet by searching for it, just try and search for the statement of financial position. But essentially, as I said in the intro, every single balance sheet is going to have three things. And if you are quickly skimming through one of these documents, they're going to stick out to you. And that is assets, liabilities, and shareholders' equity. And the first thing we're going to go over is the assets. Some companies will provide more in-depth information. You might see the balance sheet compared quarter to quarter and year over year. But for right now, Aritzia is comparing from May 31st, 2020 to March 1st, 2020. So this is a quarter over quarter comparison. So the two most important things on a balance sheet, current assets and current liabilities. We're going to go over why these are important at the end when we look at calculating working capital. But for now, let's just work line to line, top to bottom through this balance sheet. And by the end of this video, you're going to know what every single one of these terms means. And it's going to be a lot easier for you to digest the information when looking at one of these sheets. So current assets. What does current assets mean? This is essentially assets that the company owns that can be turned into actual cash within the next 12 months. So the first line, cash and cash equivalents. Obviously, cash is already in cash form. And cash equivalents would be short-term investments that the company does have that have relatively short maturity dates, like government bonds or treasury bills. So within the next, 3-4 months, those cash equivalents are going to turn into actual cash. And we can see here on a quarter-over-quarter basis, Aritzia has strengthened its cash position fairly extensively. They've nearly doubled their cash on hand. Now, accounts receivable is essentially goods that Aritzia has sold on credit, whether it be to a retailer or a wholesaler. They haven't received this money yet, but they expect to receive it within the next 12 months. And the one thing you won't see on a balance sheet, or typically won't see, is something that management has to account for in this accounts receivable area called allowance for doubtful accounts, or simply doubtful accounts. So management and investors should always know that accounts receivable, every single dollar that Aritzia sells, they're not going to receive. So management estimates the amount of money in the accounts receivable that isn't actually going to be paid, calculated on the back end, and they present to you the number of $6,159,000. So currently, Aritzia has sold $6.159 million in goods. They just haven't been paid for those goods. So considering that they've already sold the goods, it's reported on the balance sheet as an asset. So income tax is recoverable. This isn't going to be something you're going to see on every single balance sheet. And as you'll see to the right here, there is accompanying notes. So if you were reading this balance sheet and you wanted to see why the company has income taxes recoverable, because it can be for a multitude of reasons. They could have lost money in the previous year. They could have overpaid on taxes. You'll see this note 16. You're going to be able to look at the bottom of these financial statements, and it's just going to go into more detail as to why these numbers are what they are on the balance sheet. So inventory is relatively self-explanatory. I mean, there is a note in the balance sheet, and sometimes they will tell you how they calculate inventory. And I'm not going to go over it in this video, but there is multiple ways to calculate the money value of inventory. It could be something like a weighted average method, where they average out the cost of producing that inventory, or it could be something like a first in, first out method, where the goods that they produce first are assumed to be sold first. So inventory is actually a very important piece of the balance sheet. It can show you the strength or weakness of a company's product. They use things like inventory turnover, inventory to sales ratios to analyze a company's inventory. But essentially, and not in all cases, a growing inventory along with stagnant revenue is kind of an indication that interest for a company's product may have dried up a little bit. So prepaid expenses. Prepaid expenses are essentially things that a company has paid for but haven't received yet. And a lot of people may be confused as to why there is an expense in the asset portion of the balance sheet. And as a prepaid expense, if Aritzia has, say, for example, paid for raw materials to be delivered 6 months from now, they consider that essentially a cash position, because in 6 months they'll be able to produce their final product, clothing, without actually having to pay for those raw materials. And other current assets will essentially be assets that the company couldn't allot into one of these categories. And as you can see with a note, if you scroll down to the bottom of these financial statements, that note number 1 is more than likely going to tell you possibly what the prepaid expenses are and what the company's other current assets are. So that's essentially it for the current assets. And if we look right now, we have total current assets of $379,118,000. And again, we're going to do some calculations on that number later. But if we move down past the total current assets, we're still in the asset category, but we're not in the current asset category. So as we mentioned before, current assets on the balance sheet are assets that the company expects can be converted to cash within the next 12 months. These assets below are not assets that the company can quickly convert to cash. So the first one, and it actually will make a lot of sense to you watching this, is the property, plant, and equipment, or as they call it, PP&E. With property, plant, and equipment, if you're a homeowner right now, yes, you could sell your home, you could sell a piece of property quickly, but it's not an absolute guarantee. So PP&E is not listed in a current asset because it is not as liquid as something as, say, inventory, accounts receivable, or physical cash. So PP&E consists of land, buildings, equipment, even stuff like office furniture. So essentially PP&E always loses value. Think of it as a car. When you purchase a car, that car depreciates. Same with PP&E. So essentially this is the dollar value of property and equipment. And this dollar value is at original cost. So this isn't after depreciation has taken place. Intangible assets. Intangible assets are essentially things that aren't actually physical. So essentially think if Aritzia had a trademark or a patent or a particular copyright. So these are deemed as an asset and do have a value. But it's important you don't really look at the value because these intangible assets often contribute more to the ability for the company to earn more than they do as a sellable asset, so to speak. If that makes any sense. I know it's a little bit tricky to explain this. So next up we have goodwill. And the actual definition of goodwill is the chance that a customer will make recurring business with the same company because of its reputation. Prime example of this would be there's a lot of, diehard truck fans out there, Ford, Dodge, GMC. But the fact is, if somebody were to buy, one of these companies, if somebody were to buy Ford, for example, there would be a certain net asset value that Ford provides. Say, and keep in mind, I am completely making up numbers here. But say Ford has a net asset value of around $5 per share and they're acquired for $8 per share. The amount in excess of their net asset value, net asset value being $5 a share, purchase price being $8 a share, that is the goodwill. The company is willing to pay an extra $3 a share for essentially Ford's good name, their strong brand. So in terms of goodwill, you don't want too much of the total assets allocated to goodwill. Now, right of use assets. This isn't something we're going to go over too much in this video. I mean, right of use assets, they have a lot of calculations in terms of total lease liabilities, incentives that the company received upon signing leases. But essentially, a retailer like Aritzia is going to have a high amount of these right of use assets. And they're also going to be, if you jump down to the liabilities, they're also going to have a lot of lease liabilities because these companies run brick and mortar stores. So that is going to be a large portion of the company's liabilities. And as we can see, actually, jumping a little bit ahead, but Aritzia's lease liabilities are essentially half of their total liabilities. So other assets, essentially the same thing as the other current assets up top. These are just assets that the company, can't bunch into any of these other areas. So the last thing on the assets portion is the deferred tax assets, which are essentially, if you see this in the asset portion, it results from an overpayment or an advanced payment in taxes. If you see it, and we'll jump down again to the liabilities, the deferred tax liabilities, it represents income taxes owed. So overall on the assets section, you are going to get a variety of things in this area. There might be different lines that we didn't go over here. There might be particular companies that really don't carry an inventory, or there might be companies that carry significantly more PP&E. So it's important that you take the company into consideration when you're looking at these numbers as well. With Aritzia, with it being a clothing line, you are obviously going to see more things like inventory, like accounts receivable, a lot of money spent on lease agreements. So moving on to liabilities. And the first thing we're going to talk about is the current liabilities. So the current liabilities are very similar to the current assets, except it is money that the company owes and is going to come due in the next 12 months. So let's take, for example, something like bank indebtedness. This is typically a short-term loan given by the bank to a company. If we go down to note 10 and we look at section B, bank indebtedness, the company has a revolving credit facility of $100 million. So the most important thing is, as at May 31st, 2020, $100 million was drawn from this credit facility. So it's quick things like that. If you're looking at this balance sheet and you're unsure, something doesn't seem right, just head down to these notes. It's going to clear everything up. So next up on the liability section, the current liability section, is accounts payable. And essentially accounts payable is the opposite of accounts receivable. With accounts receivable, that was money that Aritzia hadn't received yet for product that it had sold. Accounts payable is money that Aritzia owes but has not paid. So a good example of this would be if you have an electrician that comes over to your house to install a new plug or fix a light. When they leave, you probably have the option to pay them right there, but most contractors will provide you with an invoice that's payable in, say, 30 days, 45 days, something like this. So income taxes payable, very easy line here. This is simply the taxes the company has due within the next year, payable to the government. So next up, lease liabilities. Now, you can see here that Aritzia has $84,607,000 in lease liabilities. They're leasing spots in malls, they're leasing spots in strip malls, stuff like that, and they do have leases on these buildings that are coming due. And if you look here, the current portion of lease liabilities, that will be a portion of the total lease liabilities, which we find a couple lines down. So next line, deferred revenue. Much like prepaid expenses, deferred revenue is essentially the opposite. This is money that Aritzia has received to deliver a product, deliver goods, whatever it may be, but they haven't actually delivered what has been paid for. So much like the prepaid expense being considered a cash asset because they'll receive whatever they paid for without the capital expense in the future, the deferred revenue means they're going to have to give product and not receive cash in return. So that is Aritzia's portion of total current liabilities, which sit at around $339,157,000. So we've gone over the current assets. We've gone over the current liabilities. And these two numbers are going to give you the most important concept on a balance sheet, which is what we call working capital. So working capital tells you a few things. It tells you the company's liquidity, essentially how efficient they are, and also its short-term financial strength. If you remember, current assets are assets that can be converted to cash within the next 12 months. And current liabilities are money owed within the next 12 months. So if you compare these two, you can get the financial health of the company over the next 12 months. So to calculate working capital, all you do is take the total current assets, which in Aritzia's case would be $379,118,000, and you subtract the total current liabilities, $339,157,000. So as of right now, as of May 31st, 2020, Aritzia has a total of $39,961,000 in working capital. So what this essentially is telling you that Aritzia is in strong financial health over the next year. So optimally, you do want to see positive working capital. There are situations where companies can operate with a negative working capital. It is not always a bad thing, but for the purposes of this initial balance sheet introduction, positive working capital is a good thing. So if we move on down the liabilities, we are going to see lease liabilities. Now, keep in mind we're outside of the current liabilities. So these liabilities up next are not due within the next 12 months. And if we see lease liabilities of around $451 million, this is the lease liabilities that are not due within the next year. So the other non-current liabilities, that's the same thing as other assets. It's liabilities that they found they can't bunch in anything else here, so they've simply listed them as other. There is a note 9, so again, you can head down to the notes in these financial statements and more than likely find out what exactly that is. Deferred tax liabilities is the opposite of deferred tax assets. This is typically taxes that Aritzia owes to the government. And finally, long-term debt of $74 million. This is about as basic as it gets. This is the long-term debt of Aritzia. This debt isn't due within the next 12 months, but as it comes due, it would be listed in the current liabilities. So we have total assets on Aritzia of $1.19 billion and total liabilities of $884 million. So as I said before, a balance sheet must always balance out. That means the total assets of a company must equal the total liabilities of a company plus its shareholders' equity. So the final portion of this balance sheet will go over the shareholder equity portion. So the first line, share capital. What exactly does share capital mean? Share capital is essentially the money that has been paid into the company by shareholders. So this is essentially the money the company has received when they issued the shares. So you're not going to see this number fluctuate unless Aritzia were to either issue shares or buy back shares. So contributed surplus is a little confusing, but essentially it is money paid over and above the par value of shares. So retained earnings. So retained earnings essentially represent the profits of the company. Now, if you have a dividend paying company, the dividends come out of these retained earnings. So for example, Aritzia has $29,519,000 in retained earnings as of May 31st, 2020. But if they had paid out $9 million in dividends, these retained earnings would be $20,519,000. So finally, the last portion on this balance sheet, accumulated other comprehensive loss. So you may see this as accumulated other comprehensive income or comprehensive loss. Either way, it's either added or subtracted to the total shareholder equity. So these losses or gains are a result from particular investments or hedging transactions the company has made. And as an end result, they've either lost money or gained money. So as an end result, we add up the share capital, the surplus, the retained earnings, and the comprehensive loss, and we have a total shareholders equity of $305,757,000. So essentially right now, Aritzia shareholders, after all debts are paid by the company, we get to the end of this balance sheet, have a claim of $305,757,000. And as you'll notice, when we get to total liabilities and shareholders equities, equals the company's total assets. That's why they often call it a balance sheet, is the fact that one end has to balance out to the other end. So we know what a balance sheet is. You know what assets are, current assets, liabilities. You know what PP&E is. I mean, you know how to look at a balance sheet now, and you understand how they work. At least I hope you do. I hope this video helped you out. So now I want to highlight two balance sheets that we're going to look over in this video. It won't take long. I just want to highlight to you a strong balance sheet versus a very weak balance sheet. So the solid balance sheet we're going to use is Shopify. The company currently has $2.727 billion in current assets and only around $288,550,000 in current liabilities. Essentially, if we look at accounts payable, income taxes payable, deferred revenue, lease liabilities, Shopify has enough cash on hand that doesn't even include other assets like their marketable securities, which are extremely liquid. They're essentially stocks, bonds, preferred shares that the company can easily sell and convert into cash. They don't even need these. The company has enough cash on hand to pay its current liabilities 3 times over. And this is important when we're looking at the balance sheet of a pure play growth stock like Shopify. We want the company to have a ton of working capital because we want them to continue to grow the business, drive top and bottom line growth. And in order to do this, companies need money. And you may be looking at these long-term liabilities and noticing one major thing missing, and that is long-term debt. And if you look at the current liabilities, another thing that might be missing is essentially any sort of debt payment. And that is because Shopify does not hold any debt. This is a company with nearly $1 billion in cash, $0.7 billion in current assets, and they hold no debt. So the company with the weak balance sheet we're going to speak on, and one that I've had a ton of questions on and have got into some pretty heated debates on, is Medmira. They are a small cap healthcare company who is currently awaiting FDA approval on some antibody tests. If we look at current assets, and keep in mind Medmira's balance sheet is not in thousands, the numbers that are listed here are the actual numbers. The company has around $422,000 in cash, $43,000 in accounts receivable. Essentially, it's listed as trade and other receivables here. $79,000 in prepaid expenses, which remember is expenses that are paid now and they don't get the product or service until later. And $110,000 in inventories for a total of around $656,000. The rest of the company's assets is essentially all in PP&E. And when we get down to the current liabilities, that is when it starts to get a little dangerous. And as we can see here, the company had around $656,000 in total cash, total assets, as in cash and receivables. If we look at these current liabilities, the company has $9.4 million in debt that is due this year. To add to that, they also have $2.4 million in accounts payable, meaning they owe suppliers $2.478 million. They also have around $1.4 million in salaries and benefits payable to their employees, around $1.7 million in interest payable, around $656,000 in deferred revenue, and $135,000 in lease liabilities, for a grand total of $16 million in current liabilities. Now, it doesn't take very long to look at this balance sheet and see a company that may not be in the best financial position right now. And if we scroll down to the equity portion, instead of shareholders equity, which we saw with Aritzia, the company actually has a shareholders deficiency of around $15.2 million. But a shareholder deficit essentially means the company has negative book value. So a lot of the times when people are asking me about Medmira and their potential, I often refer them to this balance sheet. And that's what kind of got me thinking that maybe a lot of people don't know what they're looking at. So I thought it would be really good to produce this video and help everybody out. So that's pretty much it for the video, everyone. I really hope this video helped you out. Remember, the balance sheet is one of the most important documents you're going to read when you're analyzing a company's financial position. The income statement and the cash flow statement are very important, but the balance sheet is often a very good initial screener, and it can help you avoid getting into a ton of trouble investing in speculative companies. If you got a company's balance sheet that you want us to look at, drop it in the comments. We'll have a quick look. Let us know what you spotted and let us know what you want to see next. Till next time.